Hi, welcome to Academic Market Insights. I'm Dr. Russell Rhoads, and I am joined by Dr. Adamiec. Both of us are at the Kelley School of Business. We use this space as an opportunity to talk about what's going on in the real world. We're speaking to you a couple of days after the U.S. presidential election, which I think was a big surprise to an awful lot of people. And based on one of the things that often creates volatility in the markets, creates volatility in life and everything else is surprises. And our initial reaction to those surprises is often referred to as an animal spirit. And that's a term that we use an awful lot in behavioral finance, an area that's near and dear to my heart. And I was absolutely thrilled when Dr. A said she wanted to talk about animal spirits and some of the interesting market reactions we've seen this week, and just in general, how that plays into what I always call overreactions in one direction or another. So with that, I want to hand it off to Dr. A, and then I'm going to interrupt her multiple times because I love this topic.
It really is a fun topic. And if you guys haven't seen, there is a video clip called Fear the Boom, Fear the Bust. And there's a great line in it. It says, blame low interest rates. Nah, it's the animal spirit. So we're going to talk about why some of those things can come about and how people react. And we're going to talk about some of the discrepancies that seem to be happening in the market right now, because it seems like there's lots of really great things happening, but there's also a lot of wonky things happening. And for a lot of Americans, things are still very fiscally tight for them. So people are watching their budgets. It's an interesting time period. Now, if you like this video, please hit like. And if you're interested in seeing more of our videos, please hit subscribe. And we're very open to topics, so please let us know what you'd like to hear. If you want to hear more about the animal spirit, and I hope you do, then please let us know if there's a specific area that you'd like us to target. We're very open. We're also very curious if we don't know something. Like, for example, last week we talked about REITs. That's not necessarily an area of expertise for either of us, but we enjoy digging deep and thinking about these things and figuring out, well, what will we do? Okay, so having said that, let's jump in. Okay, we're going to share a screen, PowerPoint, and let's go. They give you this big banner right in front, and you're like, it's hard to see. Okay, so the animal spirit. We're first, because we're academics, we're professors, we have to talk about a little bit of the background. So from a just theory standpoint, what does this mean? Where are we coming from? And then we'll talk about the animal spirit, and then we'll talk about the animals that are actually happening here in the markets. So a rational investor, we live
Like
in, it's
like
Michael
Mike,
Jordan.
like Mike, enemy like Mike. Go ahead. Sorry.
Drink
Come
Gatorade.
punchy. Go. Okay.
Yeah. Well, Michael is actually an example of who's not a rational investor. Okay. So we live in what could be considered a two-dimensional world in investments. We care very deeply about two things: returns and risk. We do care about other things, but for the most part, if you're considered to be a rational investor, these are what you're looking at. So you want what's called a risk-adjusted return, rate of return. And when you look at that, it is a reflection of being properly compensated for the amount of risk you're taking on. So you are going to be rewarded, and I pick on my siblings when I talk about this in class. I say my brother is a high risk, if you're going to loan money to him. My sister, low risk, right? So my sister, she'll pay you back. She'll take you out to dinner. When she pays you back, it's a great thing. My brother, and this is something else I tell specifically to my undergrads, if you loan money to your family, it should be considered a gift, not a loan. It will make life a lot easier on you. So again, high risk that you'll be be paid back with my brother. That is an old example. My brother's actually grown up quite a bit, and he's now also low risk, but it ruins the joke. So it was
Ruins it.
funnier
But
when,
yeah, what I was going to say about what's really funny about this concept here, and it's one of the first things we teach in corporate, actually in the corporate finance class. But what's funny about this is I don't think a lot of individual investors care about their risk adjusted returns. And the example I use is, let's say you got, four guys out on the golf course, and let's say they're in the South, so it's January, and they're talking about, how their money manager, how their portfolio did. If three of the guys are up 25% and one guy's up 10%, but they were really great risk adjusted returns, he's not bragging on it.
no,
No, it's individuals. Yeah, and that's one of the challenges when you're managing money for individuals, is trying to make them understand what their risk tolerance really is, not what they think it is, but
right.
what it really is. And then there's often a disconnect from that, and that is a core of behavioral finance and why we're not rational right there.
I think that's a great point. And getting to your point, Michael Jordan, I consider, and I don't know Michael personally, so I cannot say this for certainty,
Hmm.
but he is now what would be considered wealth protection. He's not in the wealth accumulation phase anymore. So we, as investors, we go through life and we're looking to accumulate wealth for retirement, to be able to bequeath our children, to build an estate. Once you hit a certain point, a certain threshold, you're no longer interested in maybe generating that 25% return. You're more interested, did I lose anything?
Good point.
And
Protection.
yeah, and Mr. Jordan is, I think, over $2 billion right now. So he is in a situation that is very different than my personal situation. And he doesn't necessarily need to be as concerned about returns. That doesn't mean he's not. And Michael, from what I understand, I've seen enough documentaries and read enough books about him, is a very competitive person. So if he's out on the golf course in January, he's of course going to be bragging to everybody about what his portfolio has done. And he'll want to make sure that he's beaten everybody. And again, those are not necessarily rational investment investor ideas.
Absolutely
And
not.
so we're introducing this idea because this is what we classically say in finance, and this is the foundation of the capital asset pricing model. This is the foundation of generating those risk premiums on these different assets, but it's not really true. We don't really behave this way. In fact, we behave more like animals. Okay, so this is where the term animal spirits came out, and we have passions for different things, and our behavior is driven by those passions. And again, as Dr. Rowe had commented, we both teach at the Kelley School of Business, and Bobby Knight is a classic example of an animal spirit. He is very driven by lots of different things.
Hmm.
So I thoroughly enjoyed the book Moneyball by Michael Lewis.
Yeah.
And in this book, if you haven't read it, and I don't want to give any spoilers, it's the idea of creating a baseball team and coming up with statistically, how do you achieve winning? And we take away some of these animals that drive us to make some of these decisions.
Hmm.
Bobby Knight, on the other hand, is very animalistic and could do things to the detriment of his team
Hmm.
because he was so reactionary uh, to what's going on. And that's another thing we should discuss. The financial markets are a little more anticipatory
Hmm.
than, let's say, compared to the federal government, which is going to be more reactionary to what the markets do. So we have built in to the financial markets, we're very forward looking, thinking what's going to happen in the next year, what's going to happen in the next 5 years. And right now, I know we're all kind of on pins and needles waiting to see what's going to happen in the next 100 days, waiting to see what's going to happen the next year, so
Mhm.
that we can have a better understanding of how to shift our targets. But again, that's a little more rational. It's that reactionary. We're
Mhm.
a little more anticipatory and we behave as such. And the first fun thing that we get to talk about is the yield curve. So we have an inverted yield curve. So normally, let me see if I can do this. Normally, a yield curve should be up and rising. Let me see if I can get
That's
close.
better than anything I've ever drawn, and that's tough.
Okay.
Yeah.
Okay.
So,
So this is,
and
sorry, I'm just going
no,
to put
no,
no.
go ahead. Yeah.
So this is what we would consider a normal yield curve. So it's upward sloping. We're looking at lower interest rates at the beginning because we have less risk because of the time value of money. And then there's a slow tapering off. So we'll notice that the 20-year versus the 30-year, there's not going to be that much of a difference. There is a substantially greater slope at the front end of the curve than compared to the back end of the curve. Sorry, I know you're excited to talk about the wonky yield
And I'm
curve.
just looking at the, yeah, and there are different spots that are more significant than others on the yield curve for the investment world. We tend to look at and the importance of the yield curve as an indicator, even if you don't own a single bond, why you should pay attention to the yield curve is the longer rates will reflect what is anticipated to happen to the shorter term rates. So when you've got those longer term rates out there at a premium to shorter dated rates, and this is not a linear chart, like 6 months out, you're circling 2 years right now. That's halfway through the chart. A lot of people
Mhm.
like to compare the 2 year and the 10 year to each other. And right now, the 2 year is at a little bit of a discount to the 10 year. If
Mhm.
you think that, if you've got an opinion of that you think that the Fed's not going to cut rates as quickly as possible, the one of the ways that you go about trading that right now is you would basically short the 2 year bonds because you're expecting the rates to go up quicker, and buy the 10 year bond because you don't expect the rate to change as much. That's just one of the ways that you would go about trading that. And right now, even though it's inverted with the very short term stuff, the 2 year versus the 10 year indicates that the market expects lower rates for a little while and expects those rates to bottom out in the next couple of years. And you can see that in a lot of other places as well. But that's the 1 month risk-free rate over there. And those are still higher, but the market is anticipating, as we sit here in November of 2024, the market expects that that risk-free number, pretty close to what you're circling there, to end up around 3.8 by the end of 2025. And that would be, if everything else kind of stays where it is, that curve would shift down, and it would be the left side of that curve that we're all looking at that would do more of a shift down than the right side of the curve. But that's I had someone, another professor recently say, if I think that they're not going to cut rates as quickly as, and I also am worried that we might get a next round of inflation, how do I go about playing that? And my first response was short the 2 year futures, buy the 10 year futures. And his response was, you're going to have to explain that to me a lot more. So it's not common. We look at that, but it's not. I don't think trading it is common knowledge. And I got to write something up about that because I think a lot of people are trying to figure out what should I do if I think we're going to get a second bout of inflation.
Right.
Um, so there.
Well, and this gets back to, again, this is one of the animal things.
Mhm.
This is not where we should theoretically should be. It doesn't change the fact that this is where we're at. And
Mhm.
there are opportunities because it seems like there is a deviation from what is a rational investor. Now, in the long run, and again, this is something that's really important, particularly in academia, and
Mhm.
academia, we will get back to that normal yield curve at some point. So Dr. Rowe is talking about how to trade this And he's talking about taking basically a spread between that short term and then the longer term and being able to make that spread. And by doing that, if enough people jump into doing that, if you sell the short end, it will force those prices down. And if you continue to buy, it will force those by the longer end, it will force those prices to go up, and it will force that curve to go back into that normal curve. So if enough people start to do this, we will reestablish the rational investor, and we will reestablish the long-term what we expect in the markets. But right now there's an anomaly. Okay. You ready to see the next animal? I'm excited. Default car loans. And this is something that you had said to me before, and I thought that this was interesting. I also have default credit cards. And this is from the CPI, or the Fed, pardon me, and this is from the Federal Reserve. So we can start to see in both of these graphs that our loan delinquency rates are going up. So people are struggling to pay back some of their car loans. And we can see that we were pretty low. This looks like in 2020, maybe even 2021, and now we've started to creep back up. So getting back to that idea of what we normally think of, we think about people paying back their loans, but we're now starting to see that people are electing to default on their car loans, and they're electing to start defaulting on their credit cards. And again, this deviates from what we would consider to be a rational or a normal investor, because a rational investor pays back their loans and they pay it back at the timely rate, and they don't default. We have these assumptions about default rates that have been very wrong. So for example, going into the financial crisis in 2008, we had, I want to say it was 0.5% was the assumed default rate for your home. So the idea, and we're not talking about homes today, I don't think we're looking at the default in homes right now, but at that time, the idea was you'll default, you'll maybe quit taking a prescription medication, you'll default on your credit card, maybe your car will get repoed, but you will always pay your home because you have to have some place to live. And we found that that wasn't true going into the financial crisis of 2008. So some of our assumptions into our models were grossly wrong and understated. So we weren't really getting a good understanding of the level of risk that individual retail clients had.
And individual, and you can flip back and forth between these two, because what I'm going to say is you can just keep going back and forth. But getting to that point where if you purchase a car that's kind of a stretch to afford, and I'll give an interesting example, and unfortunately it's a home example. But I have some friends that moved from Memphis, where I grew up, to the Chicago area, and they sold their house, I think in like 2006, 2007. And they were talking to the people that purchased their house, and it was kind of a mid-range house. The way they were going to make their mortgage payments, they were they didn't have children yet. And in order to make the mortgage payments, they were both going to work at the TGI Fridays around the corner on Fridays, Saturdays, and Sundays, in addition to their Monday through Friday 40-hour-a-week job. And because they couldn't afford the mortgage on their current income. Well, what if you're doing something like that and COVID hits? What if you're doing something like that and we have an economic slowdown, and you're not, and all of a sudden you're making half in tips what you were making the year before? So a lot of what gets you to the point of what we're looking at here, defaulting on your car loan, which is something you really don't want to do. You need your house to live in. You need your car to get to work.
You do.
I mean, we do have Uber, but still, you need your car to get to work. So that's a major decision as well, because you lose your car. It can be a a terrible waterfall, a negative waterfall impact with that as well. But irrational decisions made, buying more of a car that you can afford, spending more money on your credit card than you can afford. It's difficult not to do that because you get that instant satisfaction. It's difficult not to step up for more of a car because some people are enamored with cars, and then some people, their personality is totally linked to what they drive around, so they may overpay for you end up making an irrational entry trade. This is the bad exit trade where you're defaulting.
Well, and it's interesting you say that. I'm so glad you said that people make a stretch. I believe specifically about cars in the last 3 years, they have been stretches for a lot of people
Yeah.
because the prices for these cars have just ballooned.
Mhm.
Um, and they're selling for much more than the manufacturer's suggested retail price. And the used car area is just skyrocketed. I had a student who told me he bought a used car, sold it 6 months later, and made a profit. And I
Yeah,
thought,
I know a
what,
couple of people that have done that. Yeah, that's
what
not.
kind of world is that?
Yeah, that's part of that was supply chain issues, et cetera. Um, but yeah, that we had a very funky and the auto industry was the first industry I ever covered as an analyst in the early 90s, so it's always been near and dear to my heart. And there's nothing historically to compare with what's happened in the auto market the past 4 or 5 years with respect to part shortages, then a glut of cars, then and then you know I actually took one of our cars in for repair, and they asked me if I would be willing to trade it in because they said we really want that car in a
Yeah,
nutshell. I mean, and they're not supposed to say that, because then all of a sudden that means that they're going to should be willing to give you a pretty nice trade-in value on it.
right.
We did not trade it in, but I found that was I've never had that happen in almost 40 years of being a driver. So yeah,
Yeah.
there are huge imbalances within that market.
And again, because all of those issues is again created these prices. So now we've got these people, retail
Mhm.
investors who have made that stretch, can't afford their car loans. We've now, because we're going to jump to the price index. So
Ah.
yeah. So we've got, again, this gets back to the what we're really driven by. Prices are going up.
Mhm.
Wages haven't been able to keep up with prices. So we've got people who are stretched on a car loan because they didn't have a choice. I bought my car, last year? And I was surprised at how much money my used car cost. Just shocked. And the high interest rate. I remember 3 years ago getting a 0% interest rate for a brand new car. And that was everybody's deal, right? And this is no longer the case. So people are driven by the fact that prices are higher. So we've got higher prices, and then people are, and I'm glad you brought up that instant gratification, and we can see the default rising substantially in our credit cards. So we've got this nice upward trajectory of people not being able to pay back their credit
I don't
card.
know if I don't know if nice was a good word there.
Well,
We've got we've got an obvious uptrend,
obvious.
or there you go.
I like
Nobody
that
nobody
word.
can deny. Yeah, but I don't know. Applying that's kind of like I always have to talk about VIX at some point. That's like me being heavily involved in the VIX, excited when the VIX goes up an awful lot. But you got to remember, a lot of people, you have to temper the excitement around VIX because a lot of people are getting hurt at the same time.
Sure.
So that is here's an obvious uptrend, not a nice uptrend. But
Well, and it's
I
funny you
and
should
I know what you mean by trend, because sometimes it's difficult to pick up on a trend on a chart. That's an
this
obvious.
is
That's
this is an
that's an
obvious
easier one
trend.
to draw the line. Yeah.
Well, and it's funny you should mention that about VIX. If you remember when the carry trade around the yen started to fall apart, I
Mhm.
remember somebody being very excited about VIX going up much higher than it normally does, because it's interesting. And getting back to, let's talk about 2008 a little bit. It's
Mhm.
a very sobering reality of the individuals that are impacted. Okay, so there is a very human element, particularly about what we're talking about right now.
Oh yeah, yeah.
Yeah, being
No,
able
I
to,
just I was my waitress this morning at breakfast. I'm down in Bloomington for something that I've got to do today. My waitress this morning at breakfast is she's living in her car.
oof, yeah.
Yeah,
So
and
these are very,
she had to go out and put money in the meter because her home was but she wanted to make sure her home didn't get a ticket, as she put it. So that might be a ploy to get better tips out of me, but I don't think it was. So, but
yeah, that's,
that's you
that's
know
a story to
that's
tell then.
yeah, most definitely. So, oh, and what, just go back to that one real quick. There is one little thing I wanted to say. So, another kind of irrational thing that's going on right now, we've got prices going up, and in the normal, economic environment, higher prices are supposed to result in lower demand. We have seen, the thing that has kept the U.S. economy going in 2024 has been the U.S. consumer. So the higher prices really is not, it hasn't reached a point where it's a major behavior change for those that have discretionary income. They're still spending it, and they're probably spending it like they used to, even though they don't have it. So it's just interesting that the higher prices, the inflation that we dealt with, you're not seeing many behavior changes as far as how the consumer behaves so far, which I'm every month when we get consumer related economic numbers, I keep expecting weakness, and it's just not happening. But at some point, they're going to cut your credit cards off. So
Well, and
we'll
it's
see.
funny you should
And that's
say
a
that.
big concern for 2025.
Yeah. I
Mhm.
was discussing this with my sister earlier today, and
Mhm.
we were talking about it. I very vividly remember 2008. And
Mhm.
I remember individuals who are devastated by 2008. So we were talking about uh, potential challenges. And one of the things I said to her was, people keep spending money. And then my sister texted back to me, I guess I will stop shopping for winter skirts then. And so it's like this idea that we just keep
Mhm.
shopping and we just can't stop. Um, Last night, Nicholas is my 3-year-old, convinced me that we needed to go to the toy store. We did not need to go to the toy store.
That word
Um,
need,
yeah,
that
no
word
need.
need. So,
So another thing we need to talk about is the unemployment rate.
mhm.
To me, this is still part of the bizarro world that we're living in. Our unemployment rate isn't that high. Um, so we have weirdly these high prices. We have a high credit card debt. We have delinquency in our credit cards. We have delinquency in our car loans. We have this wonky yield curve, and yet unemployment is still
then
not that
people then
bad,
then people are spending more than they make.
right? And it's
There's our that there's our big behavioral finance non-rational anomaly right there.
right,
We're animals survive in the wild. I guess we survive in the modern world by buying stuff, or
by
at least
buying
we
stuff,
think, or at least we think that's how we're surviving. So
right?
I yeah, I feel like I should go out and buy something for myself today. If everybody else is, I'm going to too.
Well,
Like
if you don't,
I
you
need a new
won't be able to
skull
survive.
hoodie or something. Yeah, that's right. I need a new skull hoodie.
Need.
Yeah.
And interesting, I threw this in particularly because of we're talking about spending habits, the idea of the strength of the dollar. So our
Mhm.
dollar has increased in, and when we refer to strength, what we really mean is the purchasing power. How far does your dollar go to buy you something? So, for example, in 2021 and in 2020, we were trending under the dollar mark. So we were actually getting less for our dollar in the terms of being able to purchase something. This is because I come from an FX world, I think about it when you go over to another country, how far does your singular dollar go for buying something? And I know I've shared this example when we were talking about the carry trade, but again, when I was in Poland and the dollar was strong compared to the zloty, and I was able to just be able to spend more, which in my American world, I guess is very good and very exciting, which is probably why I remember this example so well. But if I've been to other countries where I don't have such exciting stories to describe. So, for example, I've been to Iceland, and Iceland, it's much more expensive. Paris, when I was in France, this was many years ago, the US dollar did not go as far. So I don't have as many delightful stories about how I was able to go out and spend a bunch of money and really live, I guess, in a very consumer world. And I had to rely more on visiting the sites and enjoying the scene and what was around me. So I really wanted to come back to this idea of how far does our dollar go relative to the fact that we are spending more than we are bringing in, the fact that prices are still going up, and that we have the delinquency in our credit cards and our car loans and that wonky yield curve. So there's a lot of unique things that are happening right now in the financial markets.
And yeah, I could make an argument with the new administration coming in that this could go either direction. I wouldn't
Oh,
even want to have I wouldn't even want to have to guess that. So
right.
there you go. Hello, new animal.
Yeah. And what was
So
also nice, and I think that's the last of the slides, but what was also nice is after he was elected, we had that huge rally. We set new
yeah,
highs. Um, the Russell 2000, the small caps. I mean, I know they've given back some of
they were
their
up 6% the day after, and that happened last time. He between his election and his inauguration, that 2 month period in there was the strongest Russell 2000 versus S&P 500 performance I think ever over that type of a time frame. And then and so everybody's all excited. Make America great again. You want to, and the Russell 2000 is the small cap index, and the majority of revenues for stocks in the Russell 2000, if you treated them as one company, is in the US. Now they've
okay.
got customers that are outside the US, et cetera. But if you take the revenues for the S&P 500, the majority come from outside the US. So the thinking here is, and this isn't like a recommendation, this is explaining the thinking. The thinking is that this whole Make America Great Again is going to be better for small companies that are focused in the US. Huge rally based on this 8 years ago. And then basically small caps underperformed pretty much the whole time he was in the office after that. So the irrationality here was loading up and then still being willing to buy small caps when they've outperformed as much as they had in January of 2021. No, goodness gracious, of 2017 when he was inaugurated. That was actually the time that the reality that you believed in was going to set in, but that was also the time to get out of that trade. So understanding the behavioral finance aspects of things like that, of reactions like we saw after the day after the election. I'm doing a road show for Indiana University right now, and my part of the road show is talking about the financial markets. I had someone come up to me after one of the discussions yesterday and ask me if they should dump all of their solar stocks because they didn't behave quite well the day after the election. And I was like, well, the Biden administration is championing these guys. The Obama administration championed these guys as well. However,
Mhm.
who's Trump going after with tariffs? And
Right.
I was trying to give her a leading question there, and she said China, and I said that's where all the solar panels are coming from right now. He may not want to he may not want to agree with Biden on anything or admit it publicly, but boosting our solar industry in the U.S., that's going to be important. It's going to be important long term. It's important for national security. So I would not worry about, a couple of day reaction to, and I think the specific stock was First Solar. I said, yeah, and she really just wanted some reassurance around that one because when I said all that, she goes, yeah, that's kind of what I thought as well. I just wanted to hear it from someone else.
That's nice.
Uh, yeah, it was kind of nice. But really, those knee-jerk reactions, especially one of the best lessons I ever learned was from a gentleman named George Hinkle who worked at Merrill Lynch forever. We called him the professor because he had a PhD in math. He actually was on the short list for possibly being the Unabomber, just
Oh,
because he was very conservative and all this other kind of stuff. But he had been interviewed about it once. But he said he'd been around for a long time. He was a great long-term thinker around the markets. And he said, whenever the market reacts to things that are purely government oriented, wait a second and see, don't fall into that trap. And I feel like this past week we've had a little bit of a post-election trap. That doesn't mean that he's not going to be good for the equity markets. He's not going to be good for small caps, but the stock market adjusted very quickly for that, and now we've got. Personally, I'm waiting to see. I'm waiting till January if I'm going to do any kind of trading that's based on what I think the administration's going to do to the markets, and that may be too late. But I just between what he says and then what's actually going to be done, I think there might be some of a disconnect there, and I'm going to wait till I see the reality. I guess I'm more rational than the average investor, which I think a lot of people that know me would be shocked to say that I'm above average in rationality.
well, and it's funny you should say and I won't touch the rationality question, or comment, but the March Fed meeting will be very interesting because again, getting into that, describing how the markets are very anticipatory and will overreact. The Fed is going to be more reactionary. And so now they're waiting to see what President Trump will do.
The Fed has got. Yeah, Powell was asked about this in his press conference for the Thursday, November 7th meeting, and he said, "By law, Trump cannot fire me.
Right.
I'm not going to quit, and I'm just going to keep doing my job." And I know a lot of people give Powell a very hard time. Um, one of the things that the Fed probably gives into animal spirits trying to fix issues that really are not part of their mandate.
Right.
And I think Wall Street doesn't like Powell as much as they liked other Fed chairs because all he ever talks about is the dual mandate. But that's what he's supposed to be doing. So I know most people are not big fans of Powell. I actually think he's one of the better Fed chairs we've had in my career because he's focused on the job of the Fed, and the job of the Fed is not to bail us all out when we buy houses that are that are beyond what we could afford, et cetera. The job of the Fed is to manage employment. You just pointed out 4.1% employment and keep that number as low as possible, but also keep inflation under control. Now,
Mhm.
inflation got a bit out of control. I don't think that was due to monetary policy. I think that was due to some fiscal policy and also, the remnants of COVID. But that's their job, and he says that. And he'll get these funky questions, and he'll say, "Well, that doesn't fall within the dual mandate," and that's like you asking me right now. What book should we teach in English literature at IU? I'm not an English professor. It's outside of my area of expertise.
Yeah. And you wouldn't want my recommendations. Let me put it that in there.
Okay.
I,
So,
yeah. And that it's very reasonable for him to be focused on his actual job. His job is big enough, and there are other things
plenty
that are
going
going
on.
on that he does
Yeah,
not need to.
there we go. So, yeah, Powell is keeping the Fed's animal spirits in check. I
Good.
like that. It's
I
I
think.
just I can't believe how much that poor guy's vilified. I just want to give him a hug.
Well, and I love how strong his no was yesterday. No, I will not be forced out of office. Okay.
Oh, this is where I'm at. So I don't think Trump's influence on the I don't think I don't think the Fed's gonna change any of its behavior. The only thing that really has changed since the election, and this was a trend that was already in place, It looks like the derivative markets now have them cutting all the way through the end of 2026, but doing it slower.
Okay.
And I'm not 100% sure of all the logic behind that, but it's just been pushed out. And it looks like we're not going to bottom out until December of 2026 instead of they did have us bottoming out at December of 2025. That might be an indication that they expect the economy to slow for a substantial amount of time, but we'll see.
But we will see.
Yep. There. So you want to take us away? You like to tell everybody, I think people react better to you than to me about subscribing and liking and all that.
Well, I'm happy to say, if you like this content, please hit like. And if you like this content, please hit subscribe. And if you are Michael Jordan and would like to sponsor us, we would love to work with you.
So
We have thoroughly enjoyed this topic, and the comment about Michael Jordan is tongue in cheek, unless he's going to do it, and then we're very open and willing to have a conversation and entertain the idea. If there is a specific topic that you would like, we are very happy to engage in any topic that is within the financial markets, nothing in English lit. We'll keep very focused on what's going on here. If you want to talk about how Bobby Knight is the biggest animal in basketball, again, that's not our topic. We can use them as a reference, but not our topic. We have thoroughly enjoyed this week's episode, and we look forward to seeing you next week. Thank you.